People say America never wanted a central bank. They say the country tried it twice, hated it twice, and then moved on. So why, in late 1913, did the United States quietly build the one thing it claimed to fear most? And why did it do it with language designed to make sure the public wouldn't call it what it was? For decades, the word central bank didn't just sound technical. It sounded foreign. It sounded like London, like private power, like a handful of men deciding how expensive money should be for everyone else. Americans didn't have to agree on much to agree on this. If you concentrated control of credit, you concentrated control of the country. The argument wasn't moral. It was practical. Whoever controlled the flow could pick winners without saying a word. But the country had a problem it couldn't talk its way out of. Money, in the most basic sense, did not behave. It flooded the system when crops moved, then vanished when bills came due. Interest rates could spike without warning. Banks could look solid on paper and collapse in a week because their cash was somewhere else. People learned to treat panic like a season, something that arrived every so often and left damage behind like a storm. The political class tried to pretend this was just the cost of freedom. Then came a year when pretending got too expensive. In 1907, the system cracked in public. The details don't matter as much as the feeling. One minute everything is normal. The next minute people are in lines, and the lines are the real news. Rumor becomes a currency. The safest bank is the one you can reach first. In that world, it isn't the weakest institutions that die first. It's the ones a crowd decide to test. The government didn't have a machine to stop it. It had no real lender of last resort, no reliable way to shove liquidity into a frozen market fast enough to change the psychology. So someone else stepped into the vacuum. Private coordination, emergency pooling, backroom arrangements that were legal, mostly because there were no better options. It worked just enough to be remembered as a rescue. And that was the problem. When private actors can stabilize the entire national credit system, the country has to choose what that means. It can call it heroism, or it can call it an indictment. A certain kind of reformer looked at 1907 and saw humiliation. The United States was the largest industrial economy on earth, and its financial system still depended on improvisation. It depended on personal trust, on gentlemen's agreements, on a few institutions capable of moving money, like a crane moves steel. That might be romantic in novels. It isn't acceptable in a state that wants to project power. Another kind of reformer saw something else. Not humiliation, a warning. If panic could be resolved by private coordination, then those private coordinators had leverage the public would never vote for. And if the fix for that was a central bank, then the fix might formalize the leverage rather than remove it. The question became sharp and uncomfortable. Do you build an institution to constrain private power, or do you build an institution that private power will learn to steer? The United States did what it often does when it wants to do something controversial. It turned it into a debate about structure. A central bank, in the European model, looked like one building, one board, one visible switchboard for the money supply. That model had a clarity Americans didn't like, because clarity comes with accountability. If one institution tightens credit and businesses fail, the public knows where to look. If one institution loosens credit and speculation ignites, the public knows where to look. So the architect of 1913 designed a different animal, something spread out, distributed, with enough regional identity to feel American. Not a single bank, but a system. Not one city, but several. Not one name that sounded like old world finance, but a name that sounded like paperwork. Federal Reserve. It didn't say bank. It didn't say central. It didn't say control. It said reserve, as if the goal was simply to hold something back, to be prudent, to keep a cushion. The language mattered because the politics were fragile. In that era, fights over money were fights over class. Farmers had their own memories. They had watched credit tighten when they needed it most. They had watched Eastern financiers talk about discipline while people lost land. They had watched interest rates become a form of weather, unpredictable and indifferent. To them, any institution that could raise rates felt like an institution that could raise rent. Industrialists had a different fear. They didn't want a system where panics kept destroying companies that were otherwise healthy. They needed long-term planning. They needed stability. They wanted capital markets that didn't feel like a roulette wheel. They were willing to tolerate regulation if regulation made the machine dependable. Big banks wanted something else again. They wanted stability, yes, but they also wanted a seat at the table. They wanted rules that formalized their position as the nodes through which credit moved. They wanted an institution that could provide liquidity in crisis. Because liquidity in crisis is not charity, it's survival. And survival favors those already large enough to receive it. Politicians, meanwhile, wanted a way to tell voters they were not surrendering sovereignty. They wanted to solve the panic problem without creating a symbol that looked like surrender. That meant compromise. And compromise in finance often means complexity. So the story of 1913 is not a story of America suddenly embracing central banking. It's a story of America refusing to call it that while building it anyway. The pressure did not come from theory. It came from repeated failure and from a global reality that was hard to ignore. By the early 1900s, other major powers had central banks that could act quickly. They could protect gold reserves, manage discount rates, and backstop their banking systems. In a world where national strength increasingly depended on industrial output and international trade, a fragile financial system wasn't just a domestic inconvenience. It was a strategic weakness. America wanted to be a modern power without adopting institutions that sounded like monarchy. It wanted to compete without admitting it was copying. So reformers pushed for something they could sell as uniquely American, a decentralized central bank, a hybrid, a structure with regional reserve banks that looked like local guardians, with a coordinating board that looked like oversight rather than command, a system that could be described as public and private at the same time, depending on the audience. That ambiguity was not an accident. It was the point. If you told a skeptical public you were creating a central bank, you'd trigger old memories and old slogans. If you told bankers you were creating a government ministry that would dictate credit, you'd trigger resistance from the institutions you needed to make it function. The only way forward was to design something that each side could interpret in its own favor. That's how you get a system instead of a bank. That's how you get regional banks with a national spine. That's how you get governance split between appointees and local directors. On paper, it looks like balance. In practice, it creates a kind of fog. And fog is useful when the thing you're building has power. Because the real question wasn't whether America would have a central bank. The real question was who would control over the levers when the next crisis hit. The panic of 1907 had shown that someone would always pull levers. If the government refused to build an institution, private actors would improvise one. If the government built one, private actors would try to influence it. In other words, the argument wasn't about whether there would be a controller. It was about whether the controller would be visible. The architects of the Federal Reserve Act had to solve three problems at once. They needed elasticity in the currency. They needed a lender of last resort. And they needed political legitimacy. Elasticity sounds harmless until you translate it. It means the supply of money can expand and contract. It means someone decides when credit is easy and when it's tight. It means the difference between businesses surviving a downturn or folding in a month. In a country suspicious of concentrated power, the idea that someone could adjust the money supply felt like giving a thermostat to a stranger and hoping they shared your definition of comfortable. A lender of last resort is even more blunt. It means in a panic, when banks hoard cash and refuse to lend, a central authority steps in and lends anyway. That authority can stop contagion. It can also decide who gets saved. The line between stabilizing the system and protecting specific institutions can be thin enough to disappear in the dark. Legitimacy was the hardest part. The United States didn't trust Washington with money, but also didn't trust Wall Street. So the act tried to make the system look like neither. It was federal but not centralized, reserved but not commanding, independent but created by law. It was designed to be defended from both directions. Then came the timing. The law passed in December. When the country was distracted, That detail is easy to romanticize and easy to overstate, but the larger reality remains. Sweeping financial architecture rarely arrives with parade. It arrives through committees, through hearings, through language no one reads carefully until it's too late. And when it arrives, it doesn't announce itself as revolution. It announces itself as reform. That's what made 1913 so effective. It didn't ask the public to change its mind about central banking. It asked the public to accept a safety upgrade. The act's framing was clinical. It wasn't selling power. It was selling prevention. It wasn't promising to steer the economy. It was promising to stop panics. It wasn't promising to reshape capitalism. It was promising to stabilize it. And that is exactly how major power expands in democracy, not by claiming new authority, but by claiming new responsibility. Once responsibility is accepted, authority follows quietly. And once a tool exists, someone will use it. Here's the pivot most people miss. The Federal Reserve wasn't just a response to panic. It was a decision to change what counted as a national emergency. Before 1913, a financial crisis was treated as a disaster the market had to endure, with limited government involvement and a lot of improvisation. After 1913, a financial crisis became something the state could manage with instruments it controlled. That shift is bigger than any one law. It's a shift in mindset. It's a shift in the definition of the state itself. A government that can shape credit conditions can shape behavior. It can cool speculation. It can stimulate borrowing. It can influence employment indirectly. It can change the cost of servicing debt, which changes what governments can afford to do. It can also create a new kind of political battlefield where the fight isn't about passing a law, but about influencing a rate. The Federal Reserve Act did not end argument. It institutionalized argument. It created a permanent arena where banking, politics, and public life collide. And it did so by hiding in plain sight. The system's very design made it hard to describe in one sentence, which made it hard to oppose with one sentence. Opponents had to explain the machine before they could criticize it. Supporters only had to say, "Do you want another panic?" That asymmetry matters. So when people say, "America refused a central bank," you can ask a sharper question. Refuse in what sense? Refuse the name. Refuse the symbolism. Refuse the simplicity. Because in 1913, America accepted the function. It accepted the necessity. It accepted the idea that money could not be left entirely to seasonal flows and private improvisation. And once the function is accepted, the institution can evolve. Over time, the Federal Reserve became the place where crisis response lives. The place where banks look when markets freeze. The place where expectations are managed through speeches, minutes, and tiny language changes that move trillions. It became an institution that could influence the economy without passing a single law through Congress. Not because it seized that power overnight, but because the country kept asking it to handle problems that elected officials either could not or would not handle directly. That's the long shadow of 1913. It's not the creation of a central bank. It's the creation of a central bank that could be defended as something else. And that leads to the open question, the one that never fully goes away. If an institution is built to be independent so it can act without politics, what happens when its actions reshape politics anyway? If it's built to be decentralized so it doesn't look like control, what happens when control still concentrates in practice around certain nodes? If it's built to prevent panics, what happens when the fear of panic becomes an argument for expanding its tools again and again? A century later, Americans still argue about the Federal Reserve the way people argue about weather. They blame it. They depend on it. They accuse it of being too powerful and then demand it fix the next crisis. They talk about it as if it's separate from politics, then treat it like the most important political institution they never vote for. So maybe the most American part of the Federal Reserve isn't its structure at all. Maybe it's the story we tell ourselves about why it exists. Not a central bank. A system, not control. Stability, not power. Independence. The same machine, softened with different words. And the real question isn't whether America wanted a central bank in 1913. The real question is whether America believed it could build one without admitting what it built.